Hey investor friends, I'm Michelle Markey and today I'm going to explain equity compensation, or also known as stock or share-based compensation. And if your company offers these financial options to you, you should definitely take advantage because they can be an incredible boost to your wealth. And equity compensation can include different forms of non-cash payouts to you as an employee. And this could be in addition to your salary or also in lieu of some of your salary as part of your overall compensation package that you get by working for a company. And so equity compensation forms could include employee stock options, restricted stock units, and or also employee stock purchase plans, or also known as stock investment plans. And if you also enjoy being a business owner or investor, I'd love if you could please like and subscribe to my video and YouTube channel, because I'm here to help us be as financially educated as we can be so we make the best decisions for our financial future. So thanks. Both public and private companies can offer equity compensation to their employees in order to motivate them to be personally invested in the financial success of the company. And I think this is a pretty great deal if you're an employee and you get to be a partial business owner or investor in the company's stock, because you get to benefit when the business generates profits. When some private companies start out as startups, they might offer some stock options or benefits if they can't afford to pay big salaries to their employees in order to make their overall compensation package more competitive in order to attract employee talent. And this could be a win-win for employees. Like, let's say that private company eventually becomes public, then those original shares in the private company might be valued at a higher price in a publicly traded stock exchange. And this could also be a win-win for employers to encourage employee loyalty. And this is evidenced by JP Morgan Chase awarding its CEO, Jamie Dimon, with 1.5 million stock appreciation rights that he can exercise over the next 5 years. So that's one way to try to keep a key employee, is by giving them some stock options that are to their benefit if the stock price were to go up. And in addition, this could be part of why more than half of people under age 35 believe that equity compensation is important. But it's kind of surprising, or maybe not surprising, that only 24% of workers have ever exercised their stock options or sold their shares that they got from their equity compensation. So this points to the fact that maybe not enough people either know about stock options or don't know how to use them or benefit from them. And even though they sound similar and even have some similar concepts between them, employee stock options shouldn't be confused with the kinds of options or derivatives that you can trade through your brokerage accounts in various kinds of securities in the stock market. And they have a similar concept where you have the right but not the obligation to buy stocks at a certain price. But the kinds of options you can trade through your brokerage, not as an employee of some company, is where you can also have the right and obligation to buy or sell securities at a certain price. So just make sure you know the difference between those two. I was inspired to create this video when I came across a recent Wall Street Journal article that showed both the power of employee options and how not enough people either know about them or understand them, and then they don't get to benefit from them. And the article profiled Brooke Harley, a former employee of Lululemon who came to them in 2009 in a business development position. And her boss at first offered her 10,000 stock options, and then she tried negotiating for 40,000 stock options, and then they finally settled on 20,000 stock options at a $10 strike price. And then over time, after 5 years, she was able to gain $1.5 million when the stock price hit $80 a share. So you can see that this was tremendously wealth building for Brooke Harley. And then she went on to create her own company and do other good things. And she moved on from Lululemon and was able to get a great financial windfall from having worked there. But then on the flip side, there's a tremendous gender pay gap in terms of stock options, where only 17% of female employees held company stock or options versus 24% of men, and $26,361 is the average value of shares held by female employees versus $104,902 value for men. And since 2002, the average value fell by $20,000 for women, while rising $30,000 for men. So for all my fellow female investors out there, I hope you will take note of all of these stats and go ask and negotiate for stock options the next time you start at a new job, because we're kind of missing out as a gender. So everybody should get to benefit from the potential rewards from stock options. So I hope everybody does their part to help educate everybody when it comes to what their options are and how they could benefit from stock options or related stock benefits from companies. When you're negotiating, working for a company, you may receive an offer letter containing compensation information such as your salary and or stock options to which you may be entitled. And I like this example from Carta, where they show an example offer letter showing an employee could receive 100 shares of option grants. And then this takes the form of a notice of stock option grant. And in this, you see the terms of the equity compensation, and I'll explain all of these momentarily. But the employee could participate in this agreement where they accept the stock options, and it's at no cost to them, and they're not obligated to actually exercise any of the options. So it's good to participate in general, even if you never end up taking advantage of the stock options, like in the event that the stock shares end up having prices that go below the strike price. And so I'll explain what these terms all mean. And the first one is that with the grant date, this is the date on which your stock options are granted to you. And you would see the number of options, which are the stock shares that are granted, where you have the right to buy this amount of shares. And the type is either incentive stock options, known as ISO, or non-qualified stock options, known as NSO. And the strike or exercise price is the price per share you can buy when options are fully vested. And the vesting schedule is the rate at which your options vest over time before you can actually buy the shares from your option grant. And the exercise window is the period of time where you can exercise the shares. And this is usually 7 to 10 years if you're still employed with the company. And the expiration date is the date on which the options expire and can no longer be exercised. And they might also expire if you leave the company. And a clawback provision is where the employer reserves the right to cancel the stock option. And the bargain element or spread is when you exercise your option. This is the difference between the exercise price and the market price of the stock, where ordinary income tax applies. So with all of these terms, I hope that was understandable, but in general, when you're given stock options, you usually have to wait for them to be able to vest over a period of time, usually 1 to 2 years. So just because you're given stock options doesn't mean that you can go out right away and buy some stocks at the strike price. You usually have to give it some time of working for a company, and then you're rewarded eventually. Like I mentioned earlier, companies may offer various forms of equity compensation that could even include phantom stocks, which are not even stocks, but are a cash bonus that are equal to the value of a defined number of shares. And I'll explain more of the general types of equity compensation that are commonly offered, such as stock options and restricted stock units or grants. And with stock options, these give you the right to buy or exercise company stock shares at the strike price, which is a preset price for a limited period of time. And there's often a vesting period before these options can be exercised, which is the minimum amount of time that must be met before you can exercise at the granted strike price. And if the company's stock price in the market is higher than your stock strike price, you could sell and lock in gains. However, if the company's stock price in the market is equal to or lower than your stock strike price, you don't gain any profit, and the stock options may expire worthless. So it may not be worth your time to exercise the options when it's in that kind of condition. And stock options can help you have skin in the game, since you don't have to invest capital until you exercise the options. And a qualified incentive stock option, or ISO, profits are often taxed at the capital gains rate, whereas non-qualified stock options, or NSO, profits may be taxed on ordinary income and capital gains tax amounts. And then with restricted stock units or grants, RSUs are granted to employees and typically vest over a period of time, You don't have to buy them, as the RSUs become shares that are given to you when the vesting period is done. And RSUs are often offered when a private company goes public and they become public in a publicly traded stock exchange. And instead of you having to invest your own capital to buy stock options, you are given these RSUs, which are equal to stock shares. And the value of the shares at the date of vest is taxed as ordinary income per Harvard Business Review. And when you are hired, your employer may offer RSUs or option grants, then refresher RSUs annually or as a bonus. And RSUs may be granted after working for a certain number of hours or years, or from meeting performance targets. So among the kinds of stock options or benefits you may expect, you'll usually come across these main two types of either stock options or restricted stock units. Let me also give you an example of what a stock option might look like. So upon joining a company, an employee receives 100 stock options where the employee is earning the options over time in the vesting period or schedule of 4 years at a strike price of $10 per share. And after working for 1 year, the employee meets the first cliff and may exercise or buy 25% of their stock options, which is also 25 stock shares. And then the remaining options, or 75 of them, will vest at a rate of 136 shares per month for each continuous month of employment, meaning the employee can exercise about 2 shares a month if they choose. And then the options terminate if the employee leaves or 10 years go by. And let's say you want to maximize your gains while minimizing your taxes. In this hypothetical example, using the 100 stock options, let's say they're fully vested now and the stock is currently trading at $11 in the stock market. So you decide to exercise your 100 stock options at $11, which means you have a gain of $100 because the strike price was $10 and you had 100 shares. So that means you have a gain of $1 per share, meaning you'll be taxed ordinary income taxes on only $100 of the gain. And then let's say you decide to hold on to those shares and then the stock is trading at $20 at some point and you finally sell at that point in time, netting you $900 of profit. And that's where you'll be taxed at a capital gains tax rate. And this could either be short-term or long-term, depending on how long you held the shares for. And this means that if you decide to exercise your options at an earlier point in time, that you could be potentially lowering your tax obligations compared to the amount of gains that you get to keep. And then to give you an example of restricted stock units or grants, let's say an employee receives an economic value of RSUs worth a total of $500 every year as long as the employee remains employed for at least 1 year, also known as the vesting period. And so each RSU is equal to 1 stock share. And then on the grant date, the company's stock's closing price is $100 per share. And then the employee gets $500 divided by $100 stock price is equal to 5 stock shares in the first year of RSU eligibility. So this is in some ways a little bit simpler than having to try to monitor stock prices with the example of the stock options I gave before this one. And this is a little bit easier to understand, where you're just granted a number of restricted stock units. And if you stay long enough with the company, then you're entitled to receive a certain number of shares. Finally, with employee stock purchase plans, this is where companies allow their employees to purchase their stock at a discount to what they're being publicly traded at in the stock market, and the discount is usually between 5 to 15%. And as an example, Starbucks has a stock investment plan where eligible employees can buy Starbucks stock at a 5% discount. So what this means is the employee will contribute between 1 to 10% of their base pay, and then at some point in the quarter, they can buy the Starbucks shares at that 5% discount. So whatever amount they contributed will be the amount that goes to buying Starbucks shares at that discount amount, and then the employee just holds on to those shares until they decide to sell them, and there's no vesting period. They just straight up own those stock shares. I hope this knowledge that I've shared with you today helps you feel empowered to review your equity compensation options and then go confidently forward if you decide to go ahead and participate and take advantage of the ability to buy some shares of your company's stock if you believe in it, and you get to benefit by getting a discount even maybe. And if you enjoyed this video or learned something, please like and subscribe, and I wish you well on your journey to being the best investor you can be. Till next time.